Well, ladies and gentlemen, my name is Greg McGlosky, and I'm with FXDD, and this is a Forex commentary for FXStreet.com. Today I'm going to talk about the New Zealand versus US dollar from a technical perspective as it approaches the 100-day moving average. Before I get into the technicals, however, we'll discuss a little bit about the fundamentals in regard to what may be going on in regard with rates and the economy over there. Obviously, New Zealand's in a favorable geographic location in relation to China and some of the other emerging countries. They're more predominantly more in agriculture as opposed to its neighbors Australia, but they benefit nevertheless from being in that region. And there's been demand for different things like dairy products and so on and so forth, which has caused their economy to rebound a little bit or more than expectation. So they are the third economy, or one of the major economies to raise rates. Australia was first, and then New Zealand raised by 25 basis points at their last meeting, and Bank of Canada has since also raised their rates by 25 basis points. All these are considered commodity currencies, and as commodities go up, as demand for commodities go up, this increases the value. So this currency has had a pretty decent run to the upside, almost, well, not quite to the highs that were reached during 2008 when the market peaked. Now rates were much higher at that time, and the carry trade was much more prevalent in those currencies. So this move that it's had so far has been rather impressive in discounting a lot of good news, let's just say, into the currency. Now, over the last month or month and a half, the market has seen a big, huge correction as flows out of the risk currency pairs, which New Zealand would be considered one, has led to a sharp decline. You can see we broke through a trend line here, and the market fell off rather sharply. I'm going to zoom in here, take a look at where we actually went for that currency pair. So after the trend line was broken, after this blue line was broken, which by the way represents the 100-day moving average, the 100 and 200-day moving average were converged up here, which kind of suggests to me that the market is in equilibrium here and is looking for a move. And lo and behold, we did get a move. We broke the trend line, we broke the 100-day moving average on the same day, and the market started to decline to the downside here. Now, the pause where the market did find has support is at the 38.2% retracement. That comes in at 65.86. The market reached levels lower than that, but really the lowest close came at this point where it was at 65.84. So it's just two measly little pips below the 38.2% retracement. And the next day you can see the market zoom to the upside, closing all the way up at 66.70, firm 90 pips above that 38.2% retracement. And from that point, the market has had like 3 or 4 or 5 good days to the upside. Now, where do we stand now? We're standing right at the looking right back at that 100-day moving average. If you recall, this day the market broke through that level. Now we're back up testing it. Yesterday we went just slightly above that, reached a high of 70.18. The 100-day moving average, by the way, came in at 70.01, and the market sold off. We sold off and we closed pretty decently or well down by at 69.45. Today the market reached a new low today, but has since climbed back up, currently trading at 69.80, so just 20 or 21 pips away from that 100-day moving average, which is bringing it back into play. Now, traders have two choices when a market approaches a borderline level like this, and this is what I consider a borderline level, because what does it say? Above it, it's bullish; below, it's bearish. But when a market approaches one of these things, the traders have an option. Okay, are you going to take profit? Are you going to sell against that 100-day moving average? In which case, look for a corrective move to the downside, or do you think the market's going to break through and trade to the upside? In which case, you might get some traders who will buy a break to the upside and look for a momentum move with perhaps a move up toward that 200-day moving average at 71.25. So the decision is in front of the trader, and that's the key level that the market's going to be looking at here against the New Zealand versus US dollar. Given the sharp move to the upside here, the chances are that we probably see some consolidation against that level. with a break just leading to a stop. It's a low risk trading opportunity. Let's see from a Fibonacci standpoint where we stand, and we are above the 50% retracement at 69.41. We're below the 61.8 at 70.31. So if we do break that 70 level, the next level would be 70.31, and then we'd be looking toward the top side at 71.24 on this chart right here. Let's take a look at the hourly chart and see what technical clues this is telling us. And if you look at this chart here, we had a nice little trend line going into the upside here. Pretty symmetrical, a couple little points along the line. In fact, 1, 2, 3, 4, 5, 6, and then the market started to break down below that level. Now we've seen a rebound off of the lows here today, as mentioned, and move back toward that 70.01 level. I'm going to put it in line at 70.01. You should probably do the same thing in your trading, just to remind yourself where the resistance is on the top side. We are running into some highs here, and that seems to be slowing it down about the 80 level. Not really, we're kind of trading right at that level, but I would expect that 70.01 level is going to provide some resistance on the top side. Nevertheless, the bias is to the upside. Why? Because we're still above the 100-hour moving average. That 100-hour moving average comes in at 68.70, and that ultimately may be a target level on the downside should the market start to move in that direction over the next few days. Additional support will probably come in against these lows that we saw here today, and you can imagine that the 100-hour moving averages be moving up toward that level as well, with perhaps a line going up in this kind of like that slope toward the beginning of the day. The 100-hour moving average will be pretty much on that low and continue in the upside direction. So from this perspective, we still have resistance against that level, but we have pretty decent support, and the expectations would be that if we do get a correction in the market, we'll find support against the 100-hour moving average. Now let's look at the 5-minute chart, and the 5-minute chart is also saying bullish. Why? Because we're above the 100-bar moving average of 69.53. We've been above that line since midday today in the trading day, when we broke above 69.23. The market moved higher, came back, tested the 100, and then started to use the 200 as our resistance level, moving up to the upside. So this chart is also saying the market is still a little bullish. Or bullish off of this chart. So let's take the Fibonacci, go down to the downside, see if we're running into a Fibonacci retracement, and we're not. So we're above the 69.65 level, which would be the next level on the downside the market's going to have to get through. Actually, we'll move this up a little bit here. So overall, this 5-minute chart is also positive for the New Zealand versus US dollar. So there's a lot going for this currency pair. Bullish on the 5-minute chart, bullish on the hourly chart, but somewhat bullish off the daily chart, only that we're near the high. The only negative, and it's probably a big negative, is a 100-day moving average where that 100-day moving average currently comes in around the 70 level on the top side, and that may trump all the other bullishness for the time being until the market should break above that level. Why should it trump that? Because it's close. We're near that level, and that level usually is a real close level that the market longer term players pay attention to, and as a result we could see some profit taking, especially after a sharp gain to the upside. And if we don't, guess what? You stop yourself out and you take your loss. So that's how I see the New Zealand versus US dollar, from a little bit from a fundamental perspective and a lot from a technical perspective. If you have any questions, you can always email me at greg@FXDD. But have a great day. This is Greg Mikulowski from FXDD with a Forex commentary for FX Street.